We had a good weekend. And just getting straight into the briefing then, discussing some of the key kind of headlines from the weekend and a look at the charts and what we're looking at for the week ahead. Starting off here, just as while I'm beginning this, gold just touching on a fresh low, so down about $10 already on the session here, just a further extension on the break now through S1 on the session. This comes with the dollar seeing some additional strength again this morning. The dollar index already trading up about 0.5%. So consequently, both major pairs already down by a fairly decent margin, about 70 to 75 pips in terms of the major pairs in euro dollar and cable this morning. Elsewhere, before we get into the actual news and the underlying reasons for these moves, the DAX seen quite a bit higher, gap up as you can see in the futures markets in my center left chart. This follows a pretty big ramp up in US equities up to once again record territory into the close yesterday, and then overnight in Asia pretty quiet. Just one word of warning, you can expect it to be fairly quiet in Asia overnight, barring anything unexpected, because it is the Chinese Golden Week, which means that basically mainland China is on holiday all week, which typically would lead to very low volumes overnight in various asset classes. Consequently, with equities higher, fixed income lower, bunds down around 30 ticks this morning. So just having a quick look here, and it has been quite interesting actually what's been a contrast in fortunes of the euro and the dollar from a fundamental perspective. It wasn't that long ago what we were talking about the kind of multi-year highs that we were printing. If I start looking at euro dollar on a daily continuation, how high we were in the euro currency and the issues that was proving potentially for the ECB's plans to further tighten policy with the risk of further appreciation of the currency. Well, since we really got above that 120, we got above 121 briefly. We have continued to pull back, and here we are sub a 118 at the moment. Now, looking slightly shorter dated here, really September and the second half of September in particular has seen quite a sharp change in direction. And partly this due to the euro, but partly due to some dynamics surrounding the Fed as well. Firstly, with Europe, politics has been a particularly interesting driver here. And that's because we had the German election, and although it wasn't a shock result, it did show that Angela Merkel had lost some ground, and it's meant that now she needs to formulate a coalition government which could take all the way up to, in terms of a market expectation, possibly up to Christmas. And so obviously that adds a bit of short-term negativity to domestic kind of stability, and this also as well translating into how far we could progress potentially in any types of talks around the Brexit situation. Now, with European politics, this was what occurred at the weekend. I'm sure you would have seen the pretty incredible scenes really that developed with the Spanish vote, Catalonia, of their independence, which was deemed by Madrid and the state as being illegal, and they were sending in forces which were, I think, heavy-handed would be a bit of an understatement, but some of the scenes where they were looking to break in and actually take the ballot boxes, physical force was being used, and this has caused a bit of a media frenzy. And early results showed that 2 million ballots were cast, nearly 1,000 people injured. But what this has meant then is, in terms of Catalonia and their officials were concerned that at 2 million then they want to push ahead, given there was around 90% backing for independence. Now, how has this impacted the market? Well, from a European point of view in FX, yes, it has added, I guess, to a little bit furthermore to European political instability. Has it really influenced the markets to a great deal? Well, probably no. Not for a spill across to broader asset classes. As you can see, European equities are still higher on the day. Market sentiment is still relatively contained. This at the moment has had much more of a domestic impact. So the Spanish over Bund 10-year benchmark spread has widened slightly, indicative of slight increase in risk for the country's debt, if you like. And then also the Spanish IBEX, their local stock market, seeing minor underperformance as well. One thing to keep in mind with this is, here's a chart of Spanish 10-year government bond yield premiums over the benchmark German Bund. And as you can see, relative to the European sovereign crisis, this by no means is at anywhere near those levels at this point. Now, what typically happens here is peripheral bonds, so countries like Italy, Portugal might also see some widening to price in a little bit of this renewed political risk. But overall, unless we start to see some real substantial escalation in these situations, not until that occurs will we start to see this really have a bigger impact across other markets. So although this is definitely something to continue to monitor in the longer term, because ultimately this push for Catalonia for its independence is certainly not going to go away anytime soon, for a short term I don't think it's going to have too much of a direct implication. The one thing I guess you have to think about is any instability obviously does make it slightly more difficult, you could argue, for the ECB to pursue its tightening mandate of tapering its QE program going into next year, if these political situations were to cause further disruption. Just looking at the euro here on the slightly longer time frame, obviously there was a fairly interesting level which was around this 118.90 to 119 level in the futures. You can see this define the kind of low that was seen late August, mid-September, support then before the eventual break that was seen on the 26th of September. When we broke that, we hit the eventual low that was seen at double bottom back on the 27th, 28th, before we rallied back up to exactly that technical point again before this last push lower. Helping this overall trade though obviously has been the other side of the coin, which is the dollar. As I said this morning, the dollar's up another 0.5%, and this comes amid really three things now that we've got, which is equating to this renewed dollar strength. One being the Fed continuation of hawkish FOMC, the quantitative tightening process now, the balance sheet to commence from this month, and then now the market pricing a December hike. The second thing is of course the corporate tax plan, which we saw unveiled last week, and the further details that have now come around from that. I think from a corporate tax point of view, it's the timing which has caught the market by a bit of surprise, it being sooner rather than later, which has been more proactive from the administration. And now thirdly, this talk about who is it that's going to be the next Fed chair. Now this was the Wall Street Journal report which circulated on Friday, but this is really kind of up the ante now, because the president himself suggesting late on Friday that a decision could be made in the next 2 to 3 weeks, which has accelerated relative to previous expectations. There's basically 4 people, as we discussed on Friday, which are potential candidates for the role of replacement of Janet Yellen, who's due to expire her term in February of 2018. Now, she of course is one person which could get reappointed. Her recent speech would suggest that potentially she wouldn't discount that being an option, but other people are other Fed members, Jerome Powell, Gary Cohn, the economic advisor currently serving under Trump, but you would say that he's probably one of the lesser favourites now given the fallout, him being slightly critical of Trump over his handling of the Charlottesville situation about 4-5 weeks ago. So Kevin Walsh was the one that prompted a quite severe reaction on the market on Friday. If you remember, that was when equities briefly dropped and the dollar rallied quite aggressively. And the reason for that is that Walsh is seen as a hawk going off his previous communication whilst he was serving as a Fed governor. He's also a Republican, and looking at Deutsche Bank this morning, they've said their take is that he is the favourite, if Trump sees deregulation as the most important criteria, and maybe him being hawkish on rates might take the pressure off the credibility issue of Mr. Trump appointing someone who will be seen as someone who would keep rates too low for too long on a political whim. So again, you've got renewed dollar strength against this catalyst of political uncertainty forming in Europe, which is calling into question then the ECB's hawkish intentions going forward. This is creating this downforce, if you like, for the euro-dollar pair. So already you can see from the overnight session we've dropped pricing in or repricing now this Spanish situation, but overall it's the ramifications that this has in the context of a stronger dollar. If we continue to move lower from here, obviously we need to keep an eye on that level of which defined the low from last week at 117.70. A break of there could be important if we're to see a further extension of this move, then targeting 117.38, the kind of mid-August low, for then potentially a bigger pullback below 117 in that instance. So that was kind of the euro situation, but amid this dollar play, let's have a look at cable. Now this is cable on a 90-minute candlestick. You can see here after hitting that 137 high, this was the kind of hawkish Bank of England that we had, followed by Flager, the Bank of England hawk dove surprisingly hawkish comments. The day after or so is when we hit those eventual top. However, the dollar strength has meant we've progressively moved lower, and actually just trading at a fairly interesting level here in cable. You can see here the high print that we originally had resistance back on the 13th, acted as support roughly on 2 occasions last week at the end of that week, and we've seen a bit of a break below that point at the moment. So Brexit talks, obviously the Tory party conference is now underway. There wasn't a great deal of movement, I'd say, in key comments. If anything, Theresa May's come under a bit of fire because she was questioned directly about, is Boris Johnson, the foreign minister, unsackable? And basically she swerved that question, didn't really answer it. She's made some concessions trying to appease the lower age category, if you like, by suggesting a freeze on tuition fees while it gets reviewed. She's also talked about renewed policies on extension of the Help to Buy scheme that should help an additional 115,000 or so new first-time buyers. That itself has come under a bit of criticism, and so nothing too much has come out of this other than I think pressure on Theresa May has kind of been something the market's really used to. I don't think it's a particularly new situation here. But to give you an idea, the Tory party conference is going on for another 2 days, so I think if you are trading the pound, you do need to be aware of some tail risk of negativity developing potentially, certainly as the Brexit talk starts to heat up. You've got the Chancellor Philip Hammond addressing the party conference today, and then probably tomorrow will be the most interesting, because if you've got the Home Secretary Rudd, the Trade Secretary Liam Fox, and then the Brexit Secretary David Davis and Foreign Secretary Boris Johnson, they're all speaking on Tuesday. And I would say David Davis and Boris Johnson then is probably, if there's going to be any potential commentary to impact sentiment on Brexit and the pound, it's probably going to come from those two, so I'll be looking out for that on Tuesday. But yeah, quite interesting here to see we're already below that point, and as I said, in the context of the stronger dollar, possibly this downside continuation could materialize. Technically less short at the 33.68 might look quite interesting in terms of the intraday. Stronger dollar, obviously gold under pressure, continuation of that move, and really this change in Fed tone has seen a very significant repricing of gold over the course of September to see off the month and the quarter. You can see we've basically gone nearly a $400 to where we are at the moment. And in terms of gold, slightly longer time frame, we're testing quite an interesting level here this morning, because down at 1273 you can see we've tested and had a slight bounce just recently, which was around the mid-August lows. Any break of there And then on the, let me change my screens here. On the intraday, you've got the S2 level down at 1269. 1269 then being a break of those levels just mentioned, and then below here 1257 is probably the next point of interest from a longer term technical level. So 1273 quite important here, but again a really nice downward trend that we've had amid this renewed upside for the dollar and this kind of reignition of the Trump trade on the corporate tax talk. Okay, want to quickly just wrap up on things and have a look at the week ahead, because I am aware that the PMI data is coming out while I'm delivering this. Just to give you an update with that, you've had the Spanish PMI 54.3. That is better than expected 53. We'll look out for the respective other numbers, particularly focus on French and Germany coming up shortly. I'll keep you updated on those as they come out. Quick look at the calendar then for today. As I mentioned, the PMIs could well set the tone for the rest of the day. Looking further forward, you do get the respective readings coming out of the US. ISM manufacturing coming out at 3 o'clock will probably be the one of main interest. From a speaker point of view, ECB's Praet speaking at Eurozone Experience with unconventional monetary policies. That could be quite interesting. And then Fed's Catalan Q&A session much later on into the evening. Looking ahead to the week, this is what it looks like. So let's move over to Tuesday. If you're trading overnight for the Aussie currency, you do have the RBA interest rate decision. Then you start the kind of suite of PMI data coming out of the UK. Really the main headline being a Wednesday for the service number. The normal API crude oil inventories coming out on Tuesday. This will be then on Wednesday, following with the DOE numbers as well. Then we get the jobs updates from the US, and of course, beginning of the month, that means we've got non-farm payrolls on Friday. So Wednesday, as per usual, we'll get ADP employment change. Investors will be watching the ISM data and its respective employment constituents to get a better idea of what non-farm payrolls could come out as. Now, one thing whilst we're speaking about non-farm payrolls is you've got to have a little bit of realization about the skew that the weather will likely have on this non-farm payrolls. Now, I did see quite an interesting comment from Deutsche Bank. They said that they were using some comparisons to previous hurricanes that had happened in the US and the implication that it had on the headline change in non-farm payrolls. So back in 2005, the initial September 2005 employment report following Hurricane Katrina showed a headline non-farm payroll reading of minus 35,000. That was after you had 3 consecutive months where the average was, up till August, 174,000. Pretty similar actually to what we're seeing at the moment on an average basis. So because of that one-off effect, the headline jobs growth was a negative 35,000. So the market discounted it as a one-off due to the weather. Now, by no means are we expecting a number quite this bad. The hurricane itself and its damage was not quite as bad as Katrina in 2005. But this is quite interesting what the guys at ING are saying. Basically, that the market will be focusing on the strength of wages as being more important than the hurricane-depressed job headline. So again, the headline is going to be ignored because of that effect. But one thing that you'll remember is this, and this is one thing to remember about the wage growth figures, because if you remember, back in August, the wage data was quite weak, but the market also looked beyond that. Why? Because August seasonally has 2 extra work days depressed August data. So basically there was more within that survey period, whereas there's 2 fewer days in September should equate to seeing a stronger reading this time round. So actually, despite a big drop in the change in the number of jobs, the wage data might actually creep up. And so is this going to really influence or ability to affect investor sentiment around the potential for a December rate hike? I think not. And I think that the fact that the market's still priced relatively high for a December hike, I really don't see non-farm payrolls disrupting that, unless in the situation where the wage data doesn't live up to this expectation, and it is equally weak. Okay, that's pretty much it. So the Italian manufacturing PMI just came out. That was a slight miss, 56.3 against 56.8. But you've got the German reading coming up in a couple of minutes' time. So I'm going to get off the mic, going to let you guys digest that piece of information and let you get on with the day. But that weekly economic calendar, I did send that out to you, and that ING bank report about payrolls is also in your inbox if you want to look at that in more detail. Okay, guys, that's it. Any questions, let me know. Otherwise, have a good day and have a good week. Thank you very much.